What people don't realize is a 1031 exchange is the way to do that for real estate. And what they're doing is they sell, they pay the taxes unnecessarily, and take what's left to go buy something else. So my goal is to have all of you appreciate how beneficial a 1031 exchange is. It's really based on the continuity of investment. So using a simple example, if I have a property, it's worth $100,000, and I owe $70,000 to the bank. So I have an investment, $100,000 investment with $30,000 of equity in it. 1031 says, if I buy another property that costs at least $100,000 and has at least $30,000 of equity, I simply shift everything from here over to here. I'm in the same exact position or better, so why should you have to pay the taxes now? That's really that's how simple 1031 is.
Welcome to Living Well with Rentwell,
the podcast for anybody who's thinking about getting into real estate, in real estate,
and wants to take their game to the next level. I'm your co-host, TJ Hawk.
And I am your co-host, Rob Coldwell. I, like many of you, have been talking to Margo for a decade, and she just always takes the time. And now her more recently, Sabrina on your staff, I had a really good Zoom with the other day, because I think we've all heard of this term, this 1031, right from the tax code, and we're like, but really, how does it work? And every situation's a little bit different, right? So we're gonna turn it over to Margo in just a minute here, but 20 plus years of experience in the space. I think you started working at the company that you later bought, or how did that go?
I started in 1994
Yeah.
as a salesperson. And back in 1994, some of you probably were not born yet, but we didn't have the internet. And it was really hard to learn about 1031 exchanges. And a funny story is when I interviewed for this job, I thought, selling 1031s, I don't even know what this is. Is this something I can do? And I spent literally about 2 hours in the Free Library of Philadelphia in Andorra with every librarian looking through the card catalogs, looking for information on 1031. I got nothing. So.
Oh, is that right? So, Tori, there were these buildings back in the day, and there were books inside of them, and they were made of paper. And you'd go there, and there was a card catalog. So I've embarrassed one person today, my team. The other one that we will be embarrassing right now is Herman's Hives, which is one of our key sponsors, $10,000 sponsorship. Thank you very much, Christina. These are jars of amazing honey made by bees, processed with love by Christina and her husband, whose affectionate nickname is Herman. So it's Herman Hives. How much? I mean, this looks like $20 worth of honey to me, just because I'm trying to inflate the price. $10 per jar. $5, $8. $8 per jar. Limited number of jars. Rob's in for 1, 2, 3, 4, 5, 6, 7, 8. Thank you. Thank you all. You all rock, because she's awesome, and we just sold out of the honey. So, that's how you get it done. All right. We also heard some feedback from, not everybody can be here live, and this is now on YouTube. It's on Spotify. We're running 30 to 45 days behind, depending on how busy Sean Dominski gets with Chad Gallagher and his landscaping crew. Chase Gallagher, sorry. So we have a basketball here now that we are also on a budget. These are $1,000 if you buy them on Amazon, but he just bought a foam basketball and put 2 microphones in it. So what this is going to be for is all of you, because the feedback on the podcast was when you all ask your questions, the listeners can't hear what you're saying. We try to repeat it back, because if you've ever been a speaker before, that's the easiest way to buy yourself some time as you're thinking about what your response is going to be, right? So I'm probably just going to try not to throw this at anybody's head and I want you to catch it. And then we'll just pass it around as there's another question. We're going to see how that goes. Could be a little clunky. We'll have some fun with it. So that's that. Craig's going to be on at the end. I love that he's another friend known for more than a decade now, and that's where we're at. So I think that's all the housekeeping. We have had some people that have successfully completed a 1031. Who all has bought an investment property in their lifetime? That's most of the room. Okay, so keep your hands up. So who has sold one of their investment properties? Great. And who has incorporated 1031 into the, so about what, dozen people or so? Okay, got it. All right, so we have some experience here.
A little bit.
Margo, I hope everybody's used you. I know that there's some other firms, but we can't think of their names right now, and they're not here. And you are. And you've always been making yourself available to all of us investors, and we appreciate that. So it was 1994. There was this library. There wasn't much research to be done in there with those books and all. But a lot has changed since then. We're in 2026.
Yes.
You're the president of the organization.
Yes.
Take it away.
So, hi everybody. So the pressure is on because I heard all of you tell me why you were here. So I have to make this really good, right? Yeah. So I am Margo McDonnell with 1031 Corp. We're a 1031 exchange qualified intermediary based in Collegeville. And this is our only business. And I did start with the company in 1994 as a salesperson. And I have to tell you, if you follow me on LinkedIn, I just posted about this. When I started all the way back then, everything that we had was written by CPAs and attorneys. And I read it and I said, I don't know how to sell this because I don't understand it. So I set the goal way back then to simplify this and to explain it in a way that everybody understands it so that you're empowered to use it. It's a great tax strategy. And you may have heard a class that I've done before, but this one's a little bit different. So we're going to go through the rules fairly quickly, and then we're going to jump into a bunch of case studies. I like the case studies because they give you examples of how you can use 1031. But I'll stick around all day and answer questions. And on the last slide that you have, it has all of my contact info. My cards are there. So you can email, you can text anytime, and I'm always happy to answer those questions. But I'm on the road a lot, so you might get a response at midnight, just a heads up. But I promise I always get back to you.
We'll be right back. But first, a word from our sponsors.
This episode is brought to you by Margo McDonnell of 1031 Corp. For over 3 decades, 1031 Corp has guided thousands of investors through smooth and secure exchanges, backed by certified exchange specialists and exceptional security of funds. We're the qualified intermediary your next move deserves. Visit 1031corp.com or call 1-800-828-1031. 1031 Corp. Build equity, preserve wealth.
This episode is also brought to you by Ocean 1031. At Ocean 1031 DST Strategies, we've spent 35 years guiding investors into Delaware Statutory Trusts. Same equity, smoother sailing. Visit ocean1031.com.
Alrighty, so that's a bit about me. So our goal is to, just like I said, give you a good overview of 1031s, and let's just skip all this and just get into it. So what exactly is a 1031 exchange? It gets its name from Section 1031 of the Federal Tax Code, and it provides that no gain or loss will be recognized on the exchange of real property, so that's property held for business use or investment. Simply put, if you're selling a rental property, any type of business use property, you can defer the gain through a 1031 exchange as long as you're buying another business use or investment property. It's really much like a sale followed by a purchase, except that you've elected to do that 1031, and we're going to have some additional paperwork and some timelines to make it all work. But I always like to use this analogy. I bet everyone here has a retirement account. And in your retirement account, you probably have a number of different funds where your money is invested. And you pay attention to that because we all want to retire someday, and we want to be able to enjoy life. So we pay attention to how those funds are doing. And if funds are not doing the way that we expected them to do, we have the ability to move money from one fund to another so that we can have a greater return on our investment. And because it's in our retirement account, it's all tax deferred. What people don't realize is a 1031 exchange is the way to do that for real estate. And what they're doing is they sell, they pay the taxes unnecessarily, and take what's left to go buy something else. So my goal is to have all of you appreciate how beneficial a 1031 exchange is. It's really based on the continuity of investment. So using a simple example, if I have a property, it's worth $100,000, and I owe $70,000 to the bank. So I have an investment, $100,000 investment with $30,000 of equity in it. 1031 says, if I buy another property that costs at least $100,000 and has at least $30,000 of equity, I simply shift everything from here over to here. I'm in the same exact position or better, so why should you have to pay the taxes now? That's really that's how simple 1031 is. Now, you could trade up, you could trade down and pay some taxes, but it allows you, IRS doesn't care about property A or property B. What they care about is that underlying investment, that $100,000 investment in real estate with $30,000 of equity. That's what's important. And we'll get into that a little bit more. These 1031s aren't new. They've been around since 1921. So for 105 years, these like-kind exchanges have been there to encourage you to reinvest. And they stay in the tax code for through every tax reform that they do, because 1031s work and they do what they were intended to do. They encourage you to reinvest. And that's good for the economy. It creates jobs, and every time you do it, you're helping the U.S. economy grow.
Can I pause there for
Yes.
one comment? So, all great. I think we got that foundation there. One thing that, when I've always thought about these, and I'm in IRL, right? As my teenage daughters say, in real life. Who all has ever felt broke as a real estate investor? That was very reassuring, especially Brad in the front row. Like, he's raising his hand. He was the guy here with the 80 units. Like, yeah, you can sometimes feel just broke. And it's not a great feeling, right? You have all this equity. So great, now I'm going to take this equity and I'm going to move it to another property. But like, I still want to like go on vacation. I want like some of my own money and all that. And what was very helpful, and this is where the conversations can go, because not everything that ChatGPT says is like completely accurate, believe it or not, right? So can we, and you might cover this at a later example, but for anybody who has this burning question like I've always had, the thinking is you take this property you've owned for a while and you transfer it over to the next property, and then this depreciation, unless you trade up, you're not like redepreciating the first property again.
You're foregoing some depreciation. We're going to talk about that in our first case study.
Got it. So what Margo and I covered on one of our last calls, and this is a good distinction to make because this is where a tax preparer does need to come in, right? It's that you can refinance that next property, the property that you purchase. You are able to refinance that one and then do some cash out from that. Now, what ChatGPT says for the timeline of what you can do that might be different from what Margo
I say a
says.
nanosecond.
Did you hear that?
What was that? I didn't hear it.
A nanosecond.
Nanosecond. This is going to challenge that.
Don't
probably.
put it on the
He's got
same
his phone
closing
out.
statement.
Yeah. So
But tomorrow, yes.
So you're saying you complete the 1031, then
Defer all the
immediately
gain.
for the refi?
Yeah.
yeah.
To cash out of it?
Yeah.
Okay.
That's
Yes.
not going to be what ChatGPT. Yeah, you know what I mean. What I try to say there. Okay, so I just wanted to put that out there because I know I am in like that position right now where I'd love some cash for me personally, have a bunch of equity. I can't. The challenge with real estate is great. You got a bunch of equity. You can't tap equity unless you sell or refinance. And if I 1031, how do I get that equity back out? Okay, so yes, and I will.
Because we're
we'll get the
experts at
basketball
deferring
going.
things.
And yeah. So
We're gonna defer that.
Just wanted to kind of put that out there, and that's why I think it you could hire somebody who's brand new at doing this, and they're not going to have the 20 plus years of experience of real life, what has happened, what has actually happened, right? That's why experience matters, and experience is what you get just after you needed it. So I hand that back to you, Margo. So thank you for letting me.
Before we get into the rules of 1031, I just want to do a quick summary of how the taxes are calculated when you sell those properties. So you have to pay tax on the gain, right? The difference between what you paid for it plus those capital improvements and what you're selling it for. And I want to take a step back for 1 second. I said it works through a business use or investment property. What a 1031 does not work on are those flips. Anything that's held for sale, so spec homes, building lots, and flips will not work. Now, maybe you stop flipping, you renovate, you put a tenant in there for a year, and then you do an exchange. It also doesn't work on a personal use property, like your primary residence or a true second home. But we'll talk about that, because you know where there's a will, there's a way. And with some planning, we can make just about anything work. But if you've held your property for less than 12 months, the gain is taxed as ordinary income. So when you're flipping properties and you hold it for 6 months, you're going to pay taxes at ordinary income tax rates, which could be as high as 37%. If you've held the property longer than 12 months, that's when cap gains kick in. And the capital gain tax rates are 15, 20%, depending on how much income you have. So that's the first federal tax we have to pay. The second one we have to worry about is the net investment income tax, which is a 3% surcharge for any individual, estate, or trust with a modified gross annual income of just $200,000. That's going to include all your profit as well, your salary, all your income. So $200,000 is actually a fairly low threshold. For a married couple, it's $250,000. And what it would do is require you to pay 3.8% surcharge on all of your unearned income. So that could include your rental income, your capital gains, interest, dividends, things like that. The third federal tax is our depreciation and recapture. We love depreciation, right? We like getting that credit for the wear and tear on our property, but a lot of people don't realize, and if you've never sold your first property, maybe you don't know that when you sell, you have to pay back or recapture 25% of all the depreciation you've taken over the years of ownership. I'm doing an exchange for somebody right now. They're selling for $7.2 million an office building on the main line that has pretty much no gain on it. But he's owned it for a lot of years and has taken millions of dollars in depreciation. Okay. So he's going to do a 1031 exchange to defer the depreciation. He's going to kick that down the road. So sometimes a 1031, even when there's no gain, makes sense. So we talked about the federal tax, and then on the state side, we have the state income tax. And fortunately, starting in 2023, Pennsylvania finally recognizes 1031, so you can defer the 3.07% to Harrisburg. But unfortunately, Philadelphia has not followed suit. So if you're selling a property in Philadelphia, or you're a resident of Philadelphia selling somewhere else, they're going to look for you for that, what is it called, BIRT, B-I-R-T tax. So any of you members of the Greater Philadelphia Association of Realtors?
I think Anil's the president of, no, I'm just kidding.
Well, I've just started talking to them, and I said, let's do this. Let's work on getting this change in Philadelphia. We were successful in Harrisburg, so let's try to do it in Philadelphia. So when you do a 1031 exchange, the goal to defer all the gain is to buy something for equal or greater value and equal or greater equity. So go back to our $100,000 example. Let's say we have $5,000 of closing cost. Our net selling price is $95,000. The new property, including closing costs, should equal at least $95,000. From that $95,000, we paid off that $70,000 mortgage, and we're left with $25,000 of equity. All of that equity needs to go into the next property. If you buy for less, or you put less equity into it, put a little bit of money in your pocket, you pay tax on that difference. It's not a percentage. If you trade it down $5, you pay tax on $5. If you trade down $50,000, you pay tax on $50,000. So sometimes trading down makes a ton of sense, but it's really important to crunch the numbers with your tax advisor in that situation. So because you have to put all of your equity from the first property into the second property, like Rob said, you can refinance afterwards. So if you call me and say, hey, Margo, I want to take some boot, which is the money you're not putting into the next one, that's the taxable portion. My first question is, do you need it right now? Because I will always encourage people to wait, complete the exchange, keep their money working for them in the next property. Because if you haven't really figured it out, a 1031 exchange lets you buy your next property with pre-tax dollars. You're growing your portfolio with pre-tax dollars. You're building wealth and preserving that equity. So a 1031 exchange gives you that immediate tax deferral, but it keeps your money working for you. It's a way for you to trade up, so you're collecting higher rents. Maybe you went from 10 properties to one large. Maybe you had 10 smaller ones, and you needed those to buy that multi-unit with 26 units. It's a way for you to consolidate. I was contacted by someone who owned Philadelphia properties. He had 146 of them in North and West Philadelphia, and he inherited them from his dad. And he wanted to sell all of those to one investor and do a DST. Just think how different life would be when his entire adult life, all he did was ever manage these properties. So buy a DST and the next day you're sleeping in, right? But it's a way for you to diversify the type of properties, the location of those properties. And because 1031s are part of the federal tax code, you can buy and sell anywhere in the US. You can sell one to buy 100 or sell 100 to buy one. You got to work with the timelines, but there are ways to make all of that work. It's a way for you to buy something with less management responsibility. It's also a way for a business owner. I heard that over here. Somebody was a business broker, right? And you're helping business owners who own real estate. Well, they can't do a 1031 exchange on any of the other business assets, but they can on that real estate. And that business owner can now exchange into something that's going to generate steady cash flow to help pay for retirement. For a business owner, it's a way to relocate their business, take advantage perhaps of some tax incentives or some SBA money at the same time. And remember I said that you can't do a vacation home? But the rules allow you to buy a rental property at the shore, rent it for 2 years, and safely convert it to your second home. Or maybe you bought I'm going to steal all the thunder for all of my case studies. So actually, I don't think I have this one. But let's say that you bought a property in Avalon in 1984.
Big money.
For $250,000.
Yep.
Wait, did I mention it's on the beach block?
You just did.
$15 million now? Even if it's still a cottage, right? Your lot is worth $15 million to someone else who's going to tear it down. Even if you did a tear down 5 years ago, they don't want yours. They want their own. But if you've never rented it, 1031 doesn't work. And you're going to pay tax on almost $15 million.
Okay.
So the key is rent it for 2 years. You change the character of the property, and all of a sudden, you get to 1031.
If you lived in it, if you had it as an investment property for the majority of that time, and then you lived in it, wouldn't work that way.
Did somebody tell me they were a tax advisor in here?
We have one in the room.
I remember.
He's taking copious notes.
They're the ones where I say, you should talk to your tax advisor. My question to you is, how is it reported on your tax return?
Okay.
Because more important than the length of time that you've rented it or owned it, it's really your intent. What was your intent? Was it always to use it for investment? Did you move out because it was harder to rent in your property? Maybe it wasn't up to standards that it didn't have all the amenities people wanted. So you took it off the market, you wanted to do some renovations to it, and then you wanted to exchange into something bigger and better where you collect higher rents. If your accountant has been reporting it on your tax return and showing some rental income, taking the depreciation, taking your mortgage interest deductions, then he's shaking his head that he feels comfortable with that.
We're in agreement.
Right.
Okay, good.
But as a qualified intermediary, I can't tell you what to do. I can have that conversation. I could offer to hop on a Zoom call and talk with your accountant and you, and ultimately it's your decision on what to do. If you tell me, hey, Margo, and this is a real life story. Hey, Margo, I'm going to sell my shore property. Okay. Is it a rental property? Meanwhile, I know him. I know that my daughter has spent weeks at his house during the summers. He's like, well, I said, it really doesn't work if you've never rented it. And he said, well, I want to buy another lot and I'm going to build our primary residence. Well, that doesn't work either. So honest to goodness, he called me the next day and said, Margo, I talked to my accountant. We're going to show some rental income for last year. I said, I'm not going to handle this for you. Like, I knew it was tax fraud. And I was like, not going there. So I can give you the information. If I know it's straight out tax fraud, I'm not going to help you with it. But I can help you get creative, right? But not that.
And some of those ways, I'm not for covering all these, but there can be times where the timing doesn't work for us as investors, where we're ready to sell now, and the property's not available to purchase, and there's ways that you can help with that, right? What's that? Is that called what's that one called?
Wait,
you have all these cliche names. So that's not the drop and swap. That's something else,
we
right?
have something. We have what we want to buy, and we don't have a buyer. Is that what you're saying?
You're ready to sell, but you're not ready to. But you haven't found. Let me change it. You have the one that you're buying, but you're not ready to sell yet. That happens the opposite
all the time. Somebody came in and said, "Hey, you're doing a webinar on reverse exchanges right now. How are you here?" Like, well, if somebody else in the company that's doing that. But a reverse exchange will let you do it backwards. And it's a great strategy in that particular situation. And I do have a case study if we get to it. I have a ton of slides. And I know that I'll stay here until 5 o'clock with all of you. But if you have
But you're like also triple booked today.
No. It's all good.
Somewhere else.
But I made sure that I printed the slides and included all the slides that I hid so that you have that as a reference. Okay. And you could go in, everyone has a goal, and it talks about how they accomplished it. So we talked about converting it to a primary residence, or you could be a primary residence or a vacation home. But you could do another exchange down the road. Somebody said they did 6, right? So you do your first exchange, you trade up a bit, you build some equity in that. Now you want to trade up into something else. And you can continue to defer the gain. And every time you do, you're just adding to the IOU you have to the IRS, right? You're reducing your basis in your old property because normally your basis is what you paid for it plus closing cost. When you do an exchange, now you deduct your deferred gain from that. So it lowers your basis. But you could do that exchange after exchange. Now you're growing your real estate portfolio with pre-tax dollars, right? Rob, 1 second. But my first 1031 conference in 1995, someone described it like this, and some of you probably heard me say it. A 1031 is like an interest-free loan from the IRS. You can increase the principal, right, by doing additional exchanges, and if you plan properly, you'll never repay it. And how do you not repay it? That's because when you pass away, your heirs inherit it with a step up in basis. So they inherit it based on the value on the date of death. And all the gain that you deferred using 1031 is all forgiven. If you came to my seminar, I don't say it anymore, it's kind of cold, but when I started this 30 years ago or 32 years ago, I would say, you had to defer, die. And that's really the key. Some people say it a little more eloquently, and they'll say swap till you drop. But but the bottom line is that this allows you to build wealth, preserve all your equity, and potentially pass it to your children with no federal taxes. In 2026, the first $15 million of someone's estate is exempt from estate taxes. For a married couple, they each have $15 million. So if one spouse passes away first and their estate wasn't worth $15 million, then whatever is left, the surviving spouse gets to port that all over and add it to their exclusion. So this is a powerful wealth building strategy. Okay, Rob.
Hold on a second here. We're going to try the basketball.
Oh boy. Watch that pizza.
For the members of the audience.
It's a little heavier than I expected.
In the face. Yeah, I hope so. He caught it, though.
He did.
Hello, YouTube. So when they go to calculate the basis, is the IRS tracking that somewhere and you can just go look it up?
Probably. The accountant behind you was saying yes.
It's on your tax return.
Passing the basketball to
It's on your
Mason.
depreciation schedule.
The answer is
if your accountant is printing out the depreciation schedule like he should be, the full depreciation detail, it's in the back of your tax return. The basis is tracked there.
So every tax return, they just like update it.
Yes, that's correct.
And Mason, plug for Mason, he has an awesome model for this that maybe he would be willing to share. Would you?
Which one is that?
That was the spreadsheet that I ended up with.
I've built so
that then
many
I
of them,
sent
I
to
don't even
you,
know.
and you said that's my spreadsheet.
Yeah, because you ended up getting it from your friend.
That's right. So we're swapping spreadsheets
I would have
over
to
here.
find it.
Okay.
Yeah.
I have it. Done some modifications. Thank you. So the basketball worked. All right, great. So it's in your tax return, and now with the large language models, you can just load your tax return into those because, how much fun is it to go find it on page whatever. And it's been very helpful for this. So thank you for that. Thank you for that question.
Just make it a private chat before you upload it to ChatGPT.
Yes.
There you go.
Yes.
And I heard that if you have a company account, that allegedly less of your data is likely to go out there. So good.
And we have a 1031 reporting guide. I can send it to Rob, and Rob can share it with everybody. Not to take business away from you, but just if somebody wants to look at it, there are some tips in there. But when you report a 1031 exchange, you're reporting it on one form. So it's really important that whoever sold the old property buys the new property so that you can put it on one form to IRS. So when they do that form, they're going to calculate the new basis based on how much gain you had on the old property and what you purchased. So that will all be there, and then you'll have your starting basis for the new property. Okay.
So if you're buying one property that's about the same price, the tax advantage is right. You've basically used up maybe a lot of your depreciation if you've owned it for a while. So is that why you mostly see clients that are trading up to larger properties so then they can start to depreciate the incremental of what they've purchased?
I see.
Versus trading it for another?
I see both.
Okay.
I see a lot of people that are looking for the same dollar amount. And so we're jumping all over, but that's okay. So when you do a 1031 exchange, right, your gain is deferred. It moves to the next property. So your basis in the new property is lowered by whatever you've deferred. If you were on a 27.5-year depreciation schedule, let's go back to our $100,000 example just to keep this easy. And let's say you owned it for 10 years. You're in year 10 of your 27.5-year depreciation life. So you will continue, for the first $100,000 of the next property you buy, you're going to continue on that old depreciation schedule for the next 17.5 years. If you bought for $200,000, that additional $100,000 increase in property value, you're going to depreciate from day one. Okay? Now, a couple of tax traps I want to tell you. If you own real property, or you own a building, and you've been depreciating the building, and you go out and you buy a building lot, and you intend someday to build a rental property on it or a future retirement home, but you can't move your depreciation schedule to vacant land. So if you sold a building to buy land, you will have to recapture your depreciation, even if it was an exchange. The other way that it's also a challenge is if you sold land. I just had someone sell land for $875,000. She bought a single-family rental, brand new, for $875,000. So she was in the same exact boat, but she has no depreciation on that new property. So, just a heads up that...
Can't depreciate it because she exchanged land for that thing, and then they're
because you
basically going off the depreciation of the land?
Well, because you can't depreciate land. So there was nothing on the old one. So for the same property value, she has nothing.
How does it? Do you know how it works with the bonus depreciation stuff that's going on now? That's pretty interesting.
So bonus when it comes to real estate?
I think he means doing
Like
the
if you
cost segs
cost
and
seg?
accelerating it. Yeah.
Okay. Yep.
Yeah.
And that was part of the problem with the client that I said they're selling for $7.2 million, but they did a cost seg analysis, right? So where they're breaking down as much of the real property into personal property assets so they can immediately expense the property, 100% of it. But if you're doing a 1031 exchange, you can 1031 that, but you're going to have to keep moving up in that situation, right? So just keep that in mind. And I don't want to, we can talk more about that. I didn't put a case study in here about that, but it will start to be a problem. If you buy a property at the shore, these days, they all have furniture in there, right? If you can allocate any of the value of the sale price, well, one, you and the seller will be really happy because you're going to lower the transfer tax that you're going to have to pay. But any allocation to the furniture in there and the spring, all those different things, you can immediately expense that. So write it off in year one. If you buy a rental property in the year of acquisition, so I know we're getting all over the place, but you have that rental property and you do some renovations and you replace all of the appliances this year, you can immediately expense right off 100% of those this year because that's your year of acquisition. So you can get really creative. So let's talk a little bit about how the 1031 exchange actually works. So this diagram is actually a great diagram because you're taking your first property, you're selling it, you're taking all the proceeds that are actually going to be held by a qualified intermediary. And I serve as a qualified intermediary. So I'm the middleman that you need to facilitate your exchange. We prepare all your documentation. We coordinate all the details with the closing agent for your old property and your new property. We do hold your sale proceeds in an account with your name and social security number attached to it. We keep you aware of all the timelines we're going to talk about next and essentially do everything we can to make it easy for you to take advantage of this. But for the day you sell your old property, and I mean go to closing, transfer title to your buyer, you have 45 days to identify the new property. And running at the same time, you have a total of 180 days to buy whatever it is that you want to buy. So it's not 45 plus 180, it's 45 plus 135 to get 180. They're based on calendar days, not business days, so that's important to know. There are no extensions. I hope there's never an extension because that means you were affected by a natural disaster and we don't want that to happen. But you have till midnight. Yes, they come in really, really late. But it's really kind of that simple. When you identify the properties, you send me a list by midnight of the 45th day. We'll give you a form letter to fill out, but you can identify up to 3 properties regardless of their combined fair market value. If you identify more than 4, we have this crazy 200% value rule that says, hey, all the properties can't equal more than twice your old property. So we see most people stick to the 3 property rule because if you sold for 100 and you want to identify 3 properties, the combined value could be $6 trillion. But if you sold for 100,000 and you want to identify 4 properties, you're capped at a total of 200,000. So if you sell for $1 million, you have more flexibility. So most people stick with that 3 property rule. The biggest advice I can give you is 45 days is going to go like that. Start looking early. And line up that replacement property. You can enter into an agreement of sale for the new property before you've closed on this. You just want to schedule the closings correctly. And I can tell you with our company, last year, our average exchange lasted 71 days. That's because people are planning ahead. And it's hard to find the perfect property, so we're seeing more people line up the property they want and then list their property if they think it's going to sell quickly. So there are timelines. Let's talk about like-kind that causes so much confusion. Yes.
The 180 days, that's plenty of time. The 45 days goes by really quick. So what I found is as soon as, do you mind? No, not at all. Can you hear me okay?
Yeah.
Okay.
Yeah, it's not the mic for the room, it's the mic for the...
Okay, yeah, the 45 days goes really quick. As soon as your property goes under agreement, start looking at properties. Look at a whole bunch of them. And then and usually you can't buy a house. I mean, you can put another house under agreement before yours is settled because a lot of times sellers won't take their property off the market. So usually the day after settlement, I start making offers. And even if the day after your settlement, you make an offer and it gets accepted, you still should name a couple of the properties. I think some people don't do that. So even though you found a replacement policy, a property, name a bunch of other properties because that one might not go through for whatever reason. That's just my advice from practical experience.
No, that's absolutely right. When you enter into the agreement of sale with a buyer, on average, you have 45 days until you close. Take advantage of those 45 days before your time clock starts clicking to try to find something that you like.
Thank you. Great.
Okay. Right. So let's talk about...
Back to... can we do one more?
Yes.
Coach Fain, I'll pass it to you, Don. Pass it back to... And he is a basketball coach officially, so it's very fitting.
Yeah, thank you.
Good to have you.
So if you sell a property, say you have no basis in it, you sell it for $2 million, so it's all gain. Can you and you want to buy an $8 million property? You want to roll your equity into that, but now it's more than 200% of what you're selling.
Oh, no! If you identify 1, 2, or 3, it doesn't matter. We only worry about that 200% rule if you identify more than 4.
Okay, so for one property, you could buy a $10 million property and just roll the equity.
Exactly.
No limit. Nice.
Exactly. So let's talk about like kind, because like kind is what causes the most confusion about 1031 exchanges. And where that name like kind comes from, that's what it's actually called. If you look at the tax code, while it's section 1031, it will go on to say like kind exchanges. But the term like kind has nothing to do with the kind of property it is. What makes two properties like kind to each other is its use. So it's the character of the property. Two properties are like kind as long as both are held for business use or investment. Like kind means I can sell a residential property and buy a commercial property. I can sell a residential and a commercial property to buy another residential property. I can sell 100 to buy one, or vice versa. And they could be anywhere in the U.S. A little fun fact is, I just told you can do an exchange domestic property for domestic property. But if you happen to own property in another country, or Puerto Rico, even though it's part of the U.S., Puerto Rico is taxed a little bit differently, so it doesn't fall within this. But if you're a U.S. resident and you own property in Puerto Rico, when you sell, you can 1031 to buy another property in Puerto Rico or any other country outside the U.S. And if some of the realtors in the room, if you are working with an investor, they were a foreign investor selling property in the U.S., they are subject to the U.S. capital gains tax too. So they can do a 1031 exchange to defer their gain and buy another property in the U.S. So just a little fun fact.
Fun facts.
So what makes makes these properties like kind is its use. And we've already touched on this. While I would say, hey, 1 to 2 years is a good rule of thumb, because you do have to tell IRS when you report your exchange, how long did you own the property? But again, more important than the length of time is your intent. What is the picture you painted to IRS through your tax reporting? Through like where, have you have anything to prove that you tried to rent it? Do you have rental income? All those things help show your intent. And I do want to just throw out there, if you have a vacation area rental, the rules say it's not a 1031 rule, it's actually section 280A of the tax code. And it says in order to qualify as an investment property, you cannot use it more than 14 days for personal use. So 14 days or 10% the number of days rented, whichever is greater. So if you bought a property at the Jersey Shore, Delaware, wherever it is, you could still use it for 2 weeks. You could pick peak season, and I'm going to guess that our tax advisor will say, hey, when you go down the weekend before Memorial Day to get it ready for your first tenants, doesn't count, right?
Substantially full-time basis.
Yes.
You have to be working on a substantially full-time basis.
So a good tax advisor will help you maximize the opportunities to spend time in your property.
4 to 8 hours per day, depending on which tax court case you're in.
Okay.
It's like having our own large language model in the room.
Well, I like that we're on the same page with everything, so that's good.
Yeah. If you need to go over a gray area, I'll just say earmuffs. To him.
Okay.
One area of gray area got saved for the end, but that's it.
Okay. He's got
so
one in the chamber. For
Here's my quick slide on the qualified intermediary. You do need to use what's called a qualified intermediary. We're a middleman. In order for us to be qualified, it has nothing to do with our qualifications. It means we're not your tax advisor, you're not your real estate professional, your attorney or a financial advisor. We can't be a close relative, employee, or a partner. We're really an independent party, and we take care of all the pieces that you need.
And if you are going from real estate to a DST,
you still need a qualified intermediary. So let me just dispel a myth about DSTs. There's not I want to do a 1031 DST or DST 1031. You do a 1031 exchange. You have a choice. After you sell, you can buy a property, like a single family property that you own 100% of and you actively manage. You could buy your multi-unit apartment building and hire Rob to manage it for you.
Yeah.
Or you could decide, you know what? I don't want to be a hands-on manager anymore. I'm going to invest in a DST or Delaware Statutory Trust. And I have a slide on that, so we'll keep going. So it's just another replacement property option.
part of the 3, if you wanted to keep
Yes.
it on a free
So you could write that into one of your slides.
Yes, and that's exactly what it would be. Now, if you're going to identify a Delaware Statutory Trust, many of them have more than 3 properties in them. So that's when you're going to use that 200% rule. Okay.
Oh, wow.
And
Okay.
we're gonna help you
Got
with
it.
that. We're gonna help you with that,
Got it.
right? I have someone that just sold a property. He was one of the people that bought land at the shore, 1978, and never built on it. He sold it for $8 million, and he's 92 years old. And his children forced him to do a 1031 exchange. He was very reluctant about it, but they wanted a Wawa, triple net lease. That's exactly what they wanted. They had $8 million to spend. It would be great. And there were a ton of them on the market until Dad sold. And then they couldn't really find any that they really liked. They finally found one. It was about $8 million. They put an LOI on it. They identified, and 3 days before closing, they're like, hey, we're not really sure that this is going to pan out. What do you think? And I said, all right, listen, I think you should, let me talk to you about a Delaware Statutory Trust. We have a list of different contacts, so we gave them a list, and they did a backup of a DST that was about $8 million. And ultimately, they pulled the plug on the Wawa. When they started doing their due diligence, they didn't think that it was worth what they wanted, so they ended up doing the DST. They did it as a backup, but ultimately it was what they bought.
So they found out early enough to have the DST listed in the first 45 days? Or?
Yes.
Okay.
And I'm sure Craig can tell you, when you have to place $8 million in a DST with like 2 days notice, it's not easy. So they really were able to make it all work.
Got it.
So I've already mentioned that when you do a 1031 exchange, you can't touch your sale proceeds. So the title company is instructed to send them to a bank account. I can tell you what we do. We set up a brand new bank account for every single exchange. So if you have 3 exchanges going right now, you've got 3 separate exchange accounts, all have your name and your Social Security or EIN number on there. And think of it as direct deposit for the replacement property. That money is just sitting, waiting till you say, hey, Margo, I need an earnest money deposit, or we need you to wire the money for our purchase. And then, of course, we're going to do all our homework. We're going to verify wiring instructions, and we're going to make sure that it's safe to wire that money out. I know you hear the horror stories, but we just had one the other day. We have an office. We just acquired a competitor in Ocean City, New Jersey. So last week I was sitting in the office, and I got a text from my second in command sitting up here in Collegeville, and she said, I think Chad just stopped wire fraud, and call me. So I called her, and typical classic example, we verified wiring instructions, day of closing. We got bogus instructions, someone pretending to be the closing agent. And we immediately responded and said, I'm sorry, we can't accept a change in wiring instructions the day of closing. And they're like, oh, and they give this whole story, and then it's like Hello, title company, like immediately call the title company. So they said, no, absolutely not our wiring instructions. So we had the right wiring instructions, so we were able to wire. The client was a little panicked because she had the bad wiring instructions also. She said, I'm going to the bank and getting a check. And that's what she did. Yeah. And the first thing we do, I'm like, okay, here's a special agent, a Secret Service guy down in Philadelphia, give them a call. So we do it. They're like, oh, 1031 Corp again. So it sounds horrible. We actually have an incentive for our team. We give them $1,000 if they stop wire fraud. Right? So they call. It's a big deal.
I had someone lose $35,000.
That's why.
Yeah.
Yes. It's more rampant than you think. Always call and verify. Alrighty, so let's keep going. You have to set your 1031 exchange up prior to closing. You could do it at closing. If you said, oh, you know what, I didn't want to do it, but I think I should do it at closing. Call us, we can make it happen. If you're walking out of closing and they're telling you, okay, we're going to wire the money now, it's too late. Because now you're in control of the money. If you could turn back around and say, hey, don't wire that money to me, you're in control. You already messed it up. Okay? So all the way up to sitting at the closing table, which happens more than you think. And the last requirement I have to tell you is you have to have the same owner, right? The same taxpayer. We've already touched on that. If Margo McDonnell sold the old property, Margo McDonnell's been reporting it on her tax return. So Margo McDonnell has to buy the new property to tell IRS I deferred all the gain and rolled it into another property. Now, any taxpayer can do an exchange. So it could be a partnership, it could be a trust, it could be a married couple, a corporation. We don't see many of them, but I have 2 this week, so I can't say never. Now let's say that it's a rental property for me, so my attorney has said, hey, don't take that in your name. Put it in an LLC. I bet a bunch of you have LLCs that you're putting these properties into. So I can form a brand new single member LLC that I'm the sole member of. And as long as it's treated as a disregarded entity for tax purposes, it's the same as me buying it. And if you're doing it in Pennsylvania, you want to take title in that LLC, you don't want to transfer it later on because they're going to hit you up for double transfer taxes. So get that all set up ahead of time. And if I want to do some estate planning, I could decide I'm going to form the Margo McDonnell Revocable Living Trust and take title that way. Because again, that's a disregarded entity for tax purposes. Yes?
What if you are
We're going to the basketball. Oh boy, that's a long throw.
Oh, he knew to move.
He's former military. I knew he was going to react well. So he's...
Is it possible if we have an LLC, you're selling a property, there are other investors who are not going to follow through with you, but you have a general partnership entity, that can move just your portion forward into an exchange?
So the quick answer is no, but, right? We'll see how creative we can get. How much time do we have before closing? Ideally, we're going to plan ahead, and you could perhaps dissolve the entity and transfer title into the individual owners as co-tenants or tenants in common. And in the ideal world, you'd also establish a holding period in each of your individual names. In real life, sometimes it's the day before, and that's when I get on the phone with the tax advisor. I raise the concerns about that. I know I've talked to IRS attorneys, right? They said, we don't have an issue with you refinancing the day after closing, but if we know it's a drop and swap, we're disallowing it. So, if you have the majority ownership and you're not really concerned about their ability to 1031, then let's redeem their interest right at closing. And they get a promissory note at closing, and the rest of the money goes into a 1031 exchange. And as long as they're willing to be cooperative, we call it a partnership installment note. So we wait 10 days, we pay out about 90% of what their piece of it was, and then it's taxable to them, and then the other 10% is paid the first business day of the following year. So we were able to take advantage of the installment sale treatment. Now, if they really had a good tax advisor, the tax advisor would say, well, don't take it all in year one, split up the gain into 2 different years. So we could do it that way. Another thing that we've seen is they exchange, and they buy different properties, and then they drop it out of the partnership down the road. So that's another creative way to do it. But that QI note or partnership partnership installment note would probably a good way to do it.
Awesome. Thank you very much.
Yep.
May have lost half the room. That's getting recorded, and we can play it back. I wasn't my preferred way to buy properties right now is to bring set myself up as a GP, have some LPs for down payment, working capital, and all that. And what Margo and I were looking at a few months ago, as we're preparing what became this talk, is doing tenants in common versus just shares within the LLC. That way, it gives everybody more flexibility for what to do at the end. So thank you for
And
that,
that's,
Margo. Craig and I are working on a deal right now, setting that structure
If you
up.
are putting something together, an attorney is going to be worth their weight in gold, and they can help you set it up. Like, think about not just what's the best way to acquire this, think about what's the best way to get out of this too, right? It's a two-part question. All right, let's do a case study. So, John has owned a single-family rental for 15 years. John paid $350,000 for it. He made no capital improvements, but over those 15 years, he took $150,000 in depreciation. He's got no debt, and now he's selling it for $600,000. He wants to buy a multifamily at the shore, which is kind of tough, right? But let's talk about his tax consequences, right? So John's an individual taxpayer. We're gonna assume he's in the 15% capital gain tax bracket. He got $250,000 of gain, and that means he's going to be subject to the 3.8% net investment income tax if he doesn't do an exchange. And he's got to take that $150,000 of depreciation and recapture to 25%. So this is how it shapes up. $250,000 of gain at 15%, $37,500. I did an estimated state income tax of 5%. Pennsylvania is 3.07%, but New Jersey, you could be over 10. So I did 5%, but $250,000 of gain at a 5% state income tax is $12,500. The 3.8% net investment income tax on $250,000 is another $9,500.
That's federal?
Federal. Yep. And then still federal, right? We have depreciation recapture. We took $150,000 of depreciation. Now we pay it back or recapture to 25%, $37,500.
And that's another estimate, right? The 25%, because there was an answer line going around that maybe you can vary a little bit. But good rule of thumb, 25%?
Yep.
Okay.
So state and federal tax liability, $97,000. This is why John doesn't sell, right? Exactly, right? You sell for $600, you give the first $100 away. So that's why John and many other investors, like probably some of you, hold onto a property longer than you should, because you look at the tax bill and say, I'm not paying that. So, but let's say, so John pays his tax, he's left with $503,000. I didn't do closing costs, but we're keeping nice, easy round numbers here. But let's say we had some good lenders here, but let's say he uses a 30% down payment to go buy something at the shore. Now he could buy for $1.67 million, right? So he could probably get 2 units that way. But if he did the exchange, he didn't have to pay that $97,000, so he has the full $600,000 to reinvest. And using that $600,000 as a 30% down payment, now he could buy for $2 million. So John immediately avoids $97,000 in federal tax. But he uses that and leverages it to buy something that's $330,000 more expensive. And whether John trades up or he just buys something for the same amount, $600,000, whatever John does in the right column, he's in a much better position. He's going to collect higher rents because that property is higher value, so he's going to collect higher rents from day one. Long-term have greater appreciation, and when he's trading up that much more, there's that much more depreciation for him to take. So for John, it's really a win-win, okay? And to follow through what we talked about earlier, in that situation, John's gain was $250,000. So his old basis carries forward, right? Or that you could say he's got that $250,000 of gain that he deferred. So if he buys for $2 million, his new basis is $1.75 million. For the first $600,000 of that new $2 million property, John will continue on his depreciation schedule for the next 12 and a half years. But he traded up $1.4 million, so he'll start depreciating that as a brand new asset. Okay? And that's where a good tax advisor will be super helpful. And he'll be super grateful that he's got great programs to keep track of all these things. Here's my next one. This is actually a big one that we did, and you're going to see strategy in this one. I was contacted by a real estate professional in Manhattan. He had a client wants to sell a brownstone with 4 units. They estimated the value to be $10 million. Okay, great. You could do a 1031 exchange. Oh, wait, the owner's been living in 2 of the 4 units? Only half of it works. So their gain, right? With the primary residence, yeah, I see that face, right? When you sell your primary residence, if you've lived there for 2 of the last 5 years, the first $250,000 is excluded from gain when you sell. And if you're a married couple filing jointly, then the first $500,000 is excluded from gain. So if they sell for $10 million, each half is worth $5 million. It was almost all gain because they bought it over 30 years ago. So they had about $4.5 million that was primary residence that didn't qualify for 1031. So they hadn't listed yet. What are the strategies? My answer is move out.
Rent it for 2 years?
Yes.
Yeah.
Move out. So they refinanced. They pulled equity out of it because they had no debt, but they pulled equity out to go buy something for them to live in, and they started renting it. And then you know what happened? COVID. So during the 2 years, but what happened to your property values in the early days of COVID? Yeah. So when they sold in 2022, they sold for $2 million more. And the entire thing qualified for 1031 treatment. But this brings up that you could have a property that qualifies for your primary residence exclusion and for 1031. So maybe the first house that you bought, maybe you have a duplex. You live in one half, you rent the other half. You want to sell that and buy something else. When you sell that, assuming that each unit is worth about the same price, the first 50% is your primary residence. So you can exclude up to $500,000 if you're married filing jointly. If you're not, maybe find a spouse, right?
That might be more than the extra $250,000.
That might cost more.
Got the ball over in there.
But you could do a 1030. So you take your primary residence exclusion on half. On the closing statement, you walk away with that check, and the other half is a 1031 exchange. We do that all the time. One closing statement, we designate what's the investment portion, what's the primary residence portion. And that could work if you're selling a farm and we carve off the house portion of it. Everything else goes into the 1031. It might be a B&B where you use a part of it as your primary residence, or a duplex. I have someone right now selling a fourplex. She lives in one. And she said, I found a triplex. Can I use one of the units for personal use? And the answer is yes, but you have to use your own money to buy it. We can't make it look like any of that 1031 equity went towards that. So she's got to match the equity going into that unit. But you can get really creative. Yes?
Just a quick question. If a personal residence and you have a lot of equity, you move out of the house, you rent the house. It's a 2-year time period, and then you can do 1031 on a primary?
That's the safest way to do it. Right, because in 2008, they issued a revenue procedure that gave us a safe harbor with a 2-year holding period. If you have a ton of gain in your primary residence, this is absolutely a strategy, right? Move out and then turn it into a rental, because when you sell, as long as you sell within the next 3 years, you still have your 2 of the last 5 years in it, or your 730 days. So you could still take your primary residence exclusion and you get to do a 1031 exchange with everything else.
So you can do both, okay.
Yep.
So we're almost out of the time for the presentation.
So can I give you one more?
Yes.
Okay, hang on, let me find a good one.
And then we're going to have Craig just put a little nightcap on this with some
Okay.
important things on DSTs, but Margo's going to stick around. Craig's going to stick around. We'll have some networking afterwards.
So Frank is a business owner, and he's selling his business, and the business owns a warehouse. Frank wants to retire, right? That's why he's selling his business, but he doesn't want to actively manage the property. So Frank paid $800,000 for his property. He's owned it forever, right? It's been his business property. And he took $300,000 of depreciation. So for Frank, he's got a $2.7 million gain. So what Frank wants is, I don't want to manage a property, right? So he's looking at an alternative replacement property option. And that's where he could use that Delaware Statutory Trust. And it's a way for someone like you or I to buy a fractional interest in institutional grade investment property. So an example might be that it has 10 Walgreens in it, and they're scattered throughout the Sun Belt. Or maybe it's 3 multifamily housing complexes, huge multifamily complexes. Maybe it's a giant, I don't want to say office building, because there's not many office buildings these days, but life sciences building, all kinds of, it could be farmland, it could be all kinds of different things now. But it lets you buy just a little piece of it. And forget that the word Delaware is in there, because it's just based on a Delaware law. So the entities are created in Delaware, but the properties that these Delaware Statutory Trusts own are all over the country. So what happens is there's a sponsor that goes out and buys properties, they fix them up, and they put financing in place, and they get tenants in there, and now they're professionally managing it. So what they do is now they make it available so you could buy a sliver of that. And if you have, let's say you sold for $600,000, you might end up with a 2.8967% interest in that. And maybe it's more, maybe it's less, depending on what you have. The DST could have one giant property in it, or it could have 5, or Craig could probably tell you about some that have many, 10 different triple net lease properties in there. And some of the benefits of doing that DST is you get that passive investment. And sometimes, Craig, were you planning to talk more about DSTs or just talk more about your, okay. So what's nice about the DSTs is they're passive, but the way they're packaged, they're treated as a security. So that's an important thing to know. So a real estate professional can't sell it to you. You need a licensed securities broker. And in order to buy a DST, you have to be an accredited investor, meaning you need to have at least $200,000 of income. For a married couple, $300,000. And anticipate having that amount of income moving forward, or have more than $1 million of net worth, excluding your primary residence. Cool. The time to use a DST would be when you just want that passive investment. It could be when you can't find replacement property. And you're going to do this either as a backup or just because you're going to preserve the tax consequence or the tax deferral. Another example would be if I sold for $600,000 and I found the one I want and it's $500,000. What are you going to do with that other $100,000? Put it into a DST. So that could just take up the excess cash. So that's kind of it in a nutshell.
Craig, you want to come up? And can we give a round of applause for Margo for just yeah, dude. Wealth of knowledge, huge heart. Thank you, Margo. Craig?
You're welcome.
Great, thanks. So since Margo talked about a DST as a security, let me give my disclaimer. So securities offered that I do through McDermott Investment Services, LLC, registered broker-dealer, member of FINRA, SIPC, and the home office is in Naples, Florida. Just let me give you some bullets on what a DST, how it can help you. It is a completely passive tool. Some of the things that Margo's already said, and it helps definitely complete a 1031 exchange. It gives your clients access to capital markets. So capital markets, like where teachers' pension funds and life insurance companies play in. And for as little as $100,000, you can invest into those types of properties. So it can be $100,000 up to more than $300 million. And it can be, as Margo said, all types of different properties. It could be apartments, industrial, life sciences, retail, medical office, self-storage. We have many other types. We just got some marinas just this recent month. And your clients can invest 100% of their proceeds into a DST. What I like to try to do is diversify. So if you have $1 million, let's say, coming out of your relinquished property, let's go into 3, 4, 5 different DSTs. I have a client that just sold a lot for $600,000. It's cheap in Avalon. And we went for $600,000, we did 6 DSTs, $100,000 each. And so he's well diversified. It can be a really good backup. So as Margo's had a really good example, I've know of other people that have tried to invest into a 1031 exchange fee simple direct ownership property and it falls apart and they didn't do a backup and now they're stuck and it's a failed exchange. If you sell a property for, let's say, $5 million and you find the perfect fee simple direct real estate property, you can buy that for $4.5 million. You've got $500,000 left over. That $500,000 left over can be a really good DST for the leftover dollars. That $500,000 could work for you as a DST. That fully then satisfies your 1031 exchange. And if your client is afraid to sell, or if you have anybody that you're trying to buy, if they're afraid to sell, let us, either one of us know. We can help them understand what the DST can do for them to be a completely passive income.
Yeah. I'm getting better. If you're exchanging into a DST, can you just write I'm doing a DST, or do you have to identify specifically?
You have to identify the specific DST and every property included in that DST.
And so doing that, and a lot of times we have several different sponsors that have more than 4 properties in the DST. So most of the times, if we ever have to identify, my goal, by the way, if somebody's doing all DSTs, is we're never going to get to that 45-day window. I can get you into a DST within 3 to 5 days, and that's really long. So we're definitely invested prior to the 45-day window. But most of the time when if we have to identify, we're doing the 200% rule.
So just buy the DST while you're in the 45-day
Great.
window.
I didn't mention that, but it's in your notes, I promise. But anything you actually acquire within the 45 days is automatically identified. So if you buy it in the 45 days, you don't have to make a formal identification.
I think you just unlock, my question, you just unlock that. That's great. I now understand that. If you do it within that window, that's where you can look at multiple of these and the DST benefit. And I'm not talking to the
I gotta let you
basketball next
Yeah,
I got
Yes.
I have a question. Okay. What if you have it in the DST? Can you then, when you later, maybe a year later or whatever, find something that you want to do a 1031? Can it come out of the DST, with the same, no tax
So
issue?
a DST is not liquid. Once you invest into the DST, you should stay in the DST. You have to stay in the DST. If you think you need to get out of it or want to get out of it prior to it going what we call full cycle, which is when it actually sells and you can do another 1031 again later,
And that's
then you
usually
shouldn't get
5
into
to
it.
7 years,
And it
would you
usually
say?
could be 5 to 7 years. I've seen it a little less, but typically 5 to even 8 years would be the sweet spot for it. And at that point in time, then you can do another 1031 out of it. But you really shouldn't, right?
There's a question behind you.
So in terms of inheritance, and if you're in a DST because you've exchanged out of your rental properties, how does that work, and what happens with like a stepped up basis or not, or any similarities there?
With the DST?
Yeah.
Yeah, it's all step up in basis. No matter what it is, it's all step up in basis. Morgan and I, we teach together, and I have a case study about the estate planning part of it and the step up in basis. This actually happened where one of our clients passed away in 2024, January. It actually went full cycle in September of that same year. Their heirs just were able to take that money from the sale and not have to pay taxes.
But if dad passes away in year 2, they should keep the money invested in that
Right.
DST until it goes full cycle, and then they get that piece of the the gain as well.
So that sounds like a really great tool for protecting against, irresponsible children at some point, right?
Yeah.
That's the best.
I've had that conversation with some people.
I think
Yep.
we have time for two.
Yeah, so my biggest pain point with working with clients and trying to talk them into DSTs, because DSTs are great strategies, is just the rate of return. Like the lower rate of return. What are you typically seeing for IRR on these deals? Normally I use it as a tool of like you had said, usually the full cycle is 5 to 8 years. So we use it as a backup to just get another bite of the apple, and you just hold it full cycle, and then you get another chance at another 1031, more active, but it's going to have higher rates of return. What are you typically seeing for IRR on these DSTs?
Well, yeah, that's something that we really got to look at on a case-by-case basis. There are some documents that we can look at from the sponsors that put them together on their track record. It can be all over the place. The cash-on-cash return initially is what we talk about, and that starts in the mid-fours.
Why do we see cash on cash? Like what?
Because
they never talk about the exit though. There's so much more.
Because you don't know what it is yet.
On the exit as well.
Because you don't know what it is yet. You don't know what the sale is yet. So you can't calculate your IRR on the sale.
I tell clients the same thing. I'm like, but that's only cash on cash. Remember, there's also an exit there.
Yeah. It's based on your percentage of ownership, and yep.
So you're saying about 4%? What you said?
Cash on cash returns are in the mid. Right now, they're in the mid 4s. We have one that's over 7, but the sweet spot's kind of in the 5% cash on cash, depending on the DST, and that's why we like to diversify, because you may have different strategies, and we also want to mitigate risk as well.
I had clients get like 8 to 12% IRR on DST.
You can. I've had it too, but we don't typically get into that up front because it hasn't happened yet, and there's no guarantee of the future results. Exactly. There you go.
Are there fees going into it? Like if I take $2 million and 1031 it into a DST, what are the fees? 3 or 4%? Or?
So there's, I say it like this: there's the real estate, the sponsor that packages the real estate together. Let's say they acquire the real estate for $50 million, then they offer it to the investors for a 1031 exchange for like $55 million. That difference is where the costs are, and that's how everybody else gets paid. So it's kind of a load that gets put into it.
So it could be 10%?
It could be 10%, yeah. But so when a client invests into a DST, you get a private placement memorandum, has to, before you can invest, that has all the disclosures in it, all the risks in it. It has all the financials in it, all the projections in it. You have to get that prior to any investing into a DST.
All right, everybody, great. Congrats.
What is how does the transfer of basis work? So if you buy $100,000 of a DST, does it look